Today's webinar is the first in a four-part series. The title of this series states Limit Orders. The reason for this type of a title is because slippage has a negative connotation associated with it. So it's like having the in-laws come to visit. However, slippage can be positive as well, and that's by using limit orders. So this four-part series is designed to share with you 4 different strategies to the market and how you can increase your chances of using positive slippage. So the strategy that I'm starting off with today is very simple. And then as we move through the weeks ahead and we get through parts 2, 3, and 4, the strategies will get progressively more challenging and then require some more skill. Now, as you guys have any questions, I do want to invite you to go ahead and type those questions into the chat box as we go along, and I'll take a few moments and answer as many questions as we have time for. And then at the very end, I will leave my contact details so that if you need any further information or further resources, we'll be able to reach out and get in touch that way. So to get started, since we are talking about limit orders and strategies that could utilize them, it's only fair that we take a moment and review some of the basic order types. And then we'll get into that strategy. So if you're familiar with these types of orders already, the market, the stop, and the limit order, I just want to invite you to hang tight here for a few minutes, for about 5 minutes or so, and then we'll be getting into the strategy in about 5 to 10 minutes. And Dry Desert, I see your question there. Do you intend to make more money with slippage? It's one of the things I'm going to share with you is how we could use slippage to our advantage and how you could set up your strategy so that you could potentially profit from slippage, because slippage is just a natural part of the market. You really don't have any control over it, but you can control whether your trade gets executed or not, and so we want to try to set ourselves up for that positive slippage. So let's start off with market orders. Market order very simply is an order to buy or sell at whatever price is trading right now. So it gets you into and out of that trade right now. With a market order, you do get guaranteed execution. The price that you get executed at could be the requested price. It could be a worse price, which would be negative slippage. Or you could get executed at a better price as well, and you could receive positive slippage on market orders. Stop orders. That is a subset of a market order in that it's an order that you place at a less favorable price in the market, and it becomes a market order when that price gets triggered. So it could happen at that requested price, it could happen at that worst price, or possibly even a better price, which is rare. Now the highlight of today is going to be the limit orders. A limit order is an order that you place in the market or at a price that is more favorable than the current market price. So let's say I'm wanting to go long a currency pair. And since I'm wanting to buy, a more favorable price to me is going to be able to buy at a lower price than the current market. So a limit entry order is going to be at a price lower in the market than the current market price. A limit take profit order, on the other hand, again, let's say I'm long in the market and I establish a take profit level that's 100 pips above where I entered into this position at. And since I'm already in the position, in order for me to close out that position, I'm going to turn around and sell. And so therefore, if I'm selling at a higher price than the current market, then that is more favorable to me. So that's where we get the limit take profit order. It gets executed at the price that you specify or better. So one of the inherent positives of using limit orders, the benefit to you is that you get to establish the price of which you want to get executed, and there is a chance that you may even get a better price, but you're not going to receive a worse price. So the limit order is what we're going to focus on because that's something that is to your advantage and positive slippage. So, slippage generally has a negative connotation associated with it, and like I said earlier, it could be like the in-laws coming to visit you. I like my in-laws, and I mean no dishonor to them, but I know that I've heard of some relationships out there where you're looking for the day that they leave. However, positive slippage, on the other hand, could be the Ed McMahon type of scenario, where it shows up, you don't really have any control over it, but you're glad that he showed up. So the strategy that we're going to get into in a few minutes includes these three cornerstones. And as a matter of fact, I think most any strategy that you come up with, like for example, the fourth part of this series, we're going to get into Fibonacci, and we're going to get into Elliott Wave. And so it's going to incorporate these elements as well. So whether you're using the MACD, whether you're using stochastics or RSI or CCI or MICKEY, whatever it is, a strategy that works over the long run is likely going to incorporate these three elements. And that's going to be the trend, that's going to be an element of support and resistance, and then some type of trade management. All right, so the strategy that we're going to focus on today is going to be a very simple type of strategy where we're going to look at charts. We're not going to have any indicators on the chart at all. And indicators are okay. Indicators, in my opinion, are secondary to the trading decisions. When you're out placing a trade in the market, you're placing a trade on the price and not on the indicator. So indicators are good at perhaps confirming what you're seeing on the price, but one can survive, in my opinion, without the use of indicators. And then we're going to focus on the limit orders that go into this particular strategy. And we've actually got a trade idea in mind here as well. So let's go ahead and get out to the chart. So pardon me for a moment. Okay, you guys should now be able to see a daily chart of the euro dollar. And I want to go ahead and I want to start off with the euro dollar. And before I do that, thank you, Harley. Dry Desert also asked as far as the slippage, not only at news events. Yes, as a matter of fact, news events is an area where you're most likely to see slippage. That's because liquidity in the market dries up, and then prices will gap and hop around. And so those situations where you may see a tendency for prices to gap or hop around is where you're going to possibly increase the chance of positive slippage if you're using entry orders. So a couple of other scenarios, news events, weekends, for example. If you hold a trade over a weekend, you get a gap. Less liquid currency pairs. If you follow something like a pound Aussie, for example, pound Aussie doesn't tend to have as much liquidity as what you're going to see on something like the euro dollar. So prices on something like the pound Aussie may have more of a tendency to hop and gap and jump around than what you would find on a more liquid currency pair like the euro dollar. So you should be able to see my chart right now. This is the euro dollar daily chart. And Boki says no pair or time frame. And you should be able to see this market scope chart. It's the euro dollar daily going back to October of 2009. Okay, awesome. Now again, the three cornerstones of a strategy, we're going to first start off with trend. And when you take a look here, let me see if I can make this bigger. All right, does that help there? First thing we're going to start off with here is trend. And we're going to pick on the euro dollar. It's been in the news lately with all the financial difficulties that the countries out of Europe have been sustaining and being able to be fiscally responsible. So one thing that we're going to start off with trend is you're going to be looking for either a series of higher highs or a series of lower highs. And in this case, on the euro dollar, going back to December of 2009, you can see we got a series of lower highs, lower lows. That did get broken here on this uptrend. But now we've got a lower high relative to December of 2009, and we're back into the mindset of creating lower highs and lower lows. So this trend is to the downside, in my opinion. Of course, we'll never know until the move is done what the ultimate trend is. And I want to highlight and focus in on this recent area because this is where we're going to draw our trade idea from. And you'll notice, so far at this point, I don't have anything on my chart. I'm just simply looking at the price action on the chart. And we had the comment by Dry Desert there a few moments ago about news events. And how does news events play into chart analysis and taking a look at trend and those types of things? And you might be surprised to find out that when it comes to my personal trading, fundamental analysis applies less than 10%. And the reason that's the case is because fundamentals will shape the longer-term trend. And so whatever the fundamental news event that comes out, it will eventually shape that trend. So the trend will go in a direction that it's going to go. I'm going to have no idea where it's going to go. I'm just simply going to follow it. And that's the whole idea behind what we're looking at here. So let me scale down to a smaller time frame chart here, and we're going to apply some support and resistance and see if we can generate some trading opportunities. And as a matter of fact, the current price at 130.60, we're right on top of an opportunity right now. And I don't know if you guys could see this or not. This is a 4-hour chart, and prices came down. It created this support shelf right near the price of where we're at right now. So let me draw a horizontal line. But like I said, let's come out here and let's place a horizontal line right below the support shelf right here. And let's just call it the 30.56 level. Make this a green line. Because back in December, prices came down, found some support, rose back up, and then eventually broke through this support. Now, for those that are familiar with technical analysis, you'll know that what was support in the past can become new resistance in the future. And so as prices broke through this green line on January the 6th, it has now come back up to retest the bottom side of this line. And so here's an opportunity where if we can see a bearish candlestick type of formation, this could be a confirmation for us to go ahead and enter this trade. Now, again, I don't have any indicators on the chart. I'm just simply using support and resistance, using candlestick formations to help confirm this trade. If you want to take that a step further, and if you want to look for additional confirmation, that's where you could add another oscillator or RSI stochastics, or you could add a MACD or something along those lines. And the neat thing about this particular trade on the euro dollar is I'm going to go ahead and scale down to an even smaller time frame chart here. Here's a 1-hour time frame. Let's zoom this in. Now, one thing that I like to do is identify channels. And so we happen to have in what is my opinion a corrective channel. So I'm drawing a support line which connects these two lines, or these two low points, and then I'm going to duplicate this line and put it right on top of the high of this wick. And a lot of times what will happen is that prices will get contained within these channels. A lot of times what will happen, sorry about that, is I just simply drew the line here connecting the lows. And then I just duplicated this line, the support line. It's become my resistance line, and I've placed it right on top of the high of this candle. And a lot of times prices will be contained inside this channel. And you can see that over the last couple of hours, prices have burst above, which does happen as well. So how I'm going to use this in conjunction with this green line is I've already established that this green line was former support. I'm looking for it to act as new resistance into the future. And then I've got this channel, which is also in the same area as well. So I've got a confluence of potential resistance coming into the same area. And that's very important to me as a trader. And here's the reason why. So let's say that you're in your house or you're in your apartment, and you want to burst a hole through the wall. So you grab a hammer, you start beating on the wall. And it doesn't take you but a couple of swings, and you're able to blow a hole through the wall. Now take that same type of scenario, go to a corner where you have two walls coming together. Take that hammer, start beating on that corner, and it'll be a lot harder. You still will be able to break through and eventually break through that corner and create a hole in that corner. But as you can imagine, because it's two walls coming together, it provides support for each other, and it makes it much more difficult for you to break through. And so that's what we have here, is we have essentially two walls coming closer together. So prices can break through, but there is that potential for overhead resistance. So we're establishing our trading idea and our trading opportunity. And right now, I mean, this is a 1-hour chart on the euro dollar. So this current candle that we see here is a 15-minute candle, or a 1-hour candle. We're only 15 minutes into this candle right now. And if it finishes out how it is, it would be a doji-like of candle that would be a bearish candlestick formation. And then we could go ahead and further establish our entry and our exit based off of this information. So what we could look at here is we want to look for some type of wick to form to the top side. Perhaps if prices start to sell off, we'll get a nice wick to the upside. We could use that wick to go ahead and enter off of this. We're a little premature. We're a little aggressive if we're going to enter in at the market right now because we don't know if this is going to be a bearish candlestick formation. We don't know if this resistance is going to hold. So it would be a little aggressive entering into this right now. And if somebody was going to enter into this right now, let's go ahead and zoom out and identify some stop levels. Probably right below some resistance, maybe around 3090. Then you got round number resistance at 3100, just above. Resistance around the low of this candle around 3090. Resistance just above at 3100. So if we were to enter into this trade in a more aggressive fashion, we're probably going to want to place a stop just above the 3100 level, like 3110 or so, just a few pips above 3100. So that would be our stop order if you're entering in at the market. And then our limit order, our take profit level, you're going to want to take twice that distance as your take profit level. And so this is where that limit order comes into play. And so if we entered in now, let's call it 3070, and we place a stop at 3110, that would be 40 pips. So that means we would look for twice that, or 80 pips, as our profit potential. So 80 pips below the current 3070 would put a take profit level around 2990, around this level. So we would still be well within inside this channel on taking profit. So the good news about being more conservative or perhaps waiting for some confirmation of these candlestick formations is that it allows us an ability to get a much tighter stop. And so with that tighter stop, we can oftentimes get a better risk to reward ratio, or we get a greater chance of the prices coming out and reaching our take profit or our limit level. So the benefit of using a limit order in this case is that if prices are successful in moving into your favor, it allows you to be able to realize those profits without being in front of your trading station. And then the second benefit of using a limit order on your trades is that if prices get a little squirrely around your limit price, it's possible you could even receive some positive slippage. If I place my take profit level, my limit take profit level around 29.90, it's possible I could get filled and executed at a lower price, realizing another pip or two on the trade. Now, if we do get a bearish candlestick formation, then one thing that I like to trade when it comes to candle formations are long wicks. So we can see back here, we had some long wicks, and this is a great example. 3 long wicks in a row. And let's say that this was the candle that we're looking at right now. We don't know what the future holds. When you see an unusually long wick like this, a lot of times what you can do is you could come out and you could place an entry order. Again, the trend is to the downside, so we're looking for a short trade. You could place an entry order, a portion halfway, 2/3 of the way up on this wick. And so you'd place an entry order around the 130.07 level. And then as you can see, a lot of times when you get a long wick, prices will come back and it will retest that wick, which is exactly what we got right here. And that candlestick formation ended up being about 70 pips or so. So on that 1 hour candle, that by itself, you would have had a fairly tight stop. You could have easily received a 1 to 2 risk reward ratio in it. So that's one thing that I look for are long wicks on candle formations. And so on this current candle, if prices were to sell off fairly significantly from this level, then I would look to place a limit entry order about halfway up on the wick. So we're only 20 minutes into this candle, so we still got 40 minutes left to go before we could really make any more conservative trading decisions off of this. But this is what we're looking at on the euro dollar. And I like your question or comment there, Dry Desert. You might get a headache if you break the wrong wall in the home. Absolutely, or your spouse may be a little upset for the air conditioning in the winter as well, if it's an outside wall. But those types of analogies are what we talk about every day at Daily FX and what we do on our live webinars. And so another way, just looking at this chart, I just realized is if you want an additional piece of confirmation on this price, if it were to drop below and be successful in moving down from here, is when it drops back inside this upper black line, that would be an additional confirmation that prices may be back on the down move, because a lot of times these channels will contain prices, and occasionally you'll get just some big blow off at the end. Prices will just shoot up, and then they'll shoot right back down. An analogy to something like that is oil. If you remember oil from several years ago, so let's go ahead and take a look here at oil. Sorry about that delay. So yeah, you can see here on oil, you can see how this thing went straight up, and then once it finally reached its pinnacle, then it dropped significantly from there. And oil, by the way, is another interesting topic of conversation right now, because on the drive to work this morning, it's about $3 a gallon here in Texas for gas, and so there's a lot of attention being brought to the price of oil and the price of gasoline. But if you look at it on a relative basis, we had a very strong sell-off, and it's only retraced a portion of that. And look how long it's taken to retrace that steep sell-off. So although there may be some underlying strength in oil, it's not anything that's been going crazy in a strong trend, like silver, for example, or gold. And those are even a currency pair related. The Euro-Aussie is a currency pair that's been in an incredibly strong trend as well. Let's go ahead and check out the Euro-Aussie. You're actually able to see my Euro-Aussie chart. So here's the Euro-Aussie, and if this is something that you haven't added to your regular trading repertoire, I would encourage you to do so, because since the beginning of 2009, this thing's dropped 8,000 pips. So as a trader, when I talked about one of the cornerstones of trading, and that being trend, you want to be able to go out and look and identify some of the strongest trends out into the market. And the Euro-Aussie has certainly been one of those trends, because on a relative basis, the euro has been weak. The problems with Greece and Portugal and Spain, those have been around for several years. It's just that every now and then, the sentiment in the market, the sentiment in the major news channels revs up and revs down. It ebbs and flows. And then likewise, the Australian dollar has been fairly strong over recent times. They've had the higher relative interest rate, so you've got money flowing towards the Australian dollar. And I understand they've had some serious flooding down there, and we definitely want to keep the Australians in our thoughts, as there's a lot of people that have been displaced, a lot of people that have been hurt, and a lot of property damage as a result of it. But the other thing that we want to keep in mind, I mentioned a little bit earlier in this webinar about fundamentals, and that fundamentals plays into less than 10% of my trading decisions. And one of the fundamentals that I am looking at right now is that I do think over the long run, I think we are going to see some dollar strength. So that's why I like that euro-dollar short, because you've got the euro, which is arguably one of the weakest currencies right now, and then you've got a potential for the U.S. dollar to get strong. Why do I think there's that potential for that U.S. dollar to get strong? Well, if you take a look here at this chart, and this line graph that you're seeing is the dollar index. It was up as high as 89 back in June. It dropped all the way down to 75 and change here in November. And now it's working its way higher. And in the context of trend, you can see we have a lower low, we've got a lower high, lower low, and now we're starting to put that into jeopardy. I'm going to draw a horizontal line here across this 81.30 level. And again, as you guys have any questions or comments, go ahead and type those into the chat box. You see this red line, it acted as resistance back in late November. And then we got a little bit of a sell-off from it, and now we're coming up and we're testing this level again. So if and when we break above this red line, that is going to be an indication that dollar strength is reemerging. And that'll be the confirmation that will give us more comfort in this euro-dollar short. And then the next level of resistance, if we can break through, would be around this 83.30 level. But eventually, I think we're probably going to see this upper bound of 89 get put to the test. And the reason I think that's going to be the case is if we scale this dollar out to a weekly chart, you can see that we recently approached 89 back in 2009. We created a higher low, could not quite break through that 89 level, created another higher low. So I like the prospects of this coming back up to this former resistance level. So again, if you're out there, regardless of what your strategy is and what it is that you're looking to trade, take a look at limit orders. Limit orders is a way for you to be able to help stack the cards in your favor to try to set up for the Ed McMahon type of situation where he's coming to your house with a sweepstakes prize. Here's a few extra dollars that you weren't planning on, but I'm going to go ahead and give those to you. You have that possibility when you're using a limit order, be it a limit entry order or a limit take profit order on your trades. What's the bias on, I see the question in there, Plu, on the dollar CAD considering the oil price move? And that's a good question. Let's pop up the dollar CAD. And let me get rid of this line here. The other thing I'm going to do, actually let me pull up my other chart here for a moment, just a minute. All right, so here's our price of oil. Let me start off with the dollar CAD here. Let's look at a daily chart. And then I'm going to overlay the price of oil on top of this. And let's zoom this out. This is a daily chart, and you can see here lately that the dollar CAD, so basically there's an inverse relationship between them. As the dollar CAD goes down, the price of oil tends to move up, and I lost my chart again there. Let's try this again. There we go. As the dollar CAD moves down, the price of oil tends to move up. That's at least what the historical correlation has been between these two currency pairs. And so if you're doing some type of correlation trading, then you're going to be looking for some divergence in that correlation. And when you see that divergence, then you could go ahead and make a bet or make a trade based on that divergence. So you could see here that as dollar CAD moves up, oil moves down. As dollar CAD moves down, oil moves up. Now, the interesting difference between these two instruments is on oil, it reached its peak of $140 plus dollars a barrel in 2008, and it's only retraced maybe 50% of that move. But in the context of the dollar CAD reached its peak back in 2007, at least on Canadian dollar strength, and it's retraced, it looks like maybe 78% of this move, 61 to 78% of this move. So on a relative basis, the dollar CAD, has been stronger than oil. Just a second. Throw a retracement out here, and it looks like it's done about 78% of this level. And yes, you can see right here, 78%. Now, as far as a Fibonacci level, many of you may not be concerned or may not have heard. Let's try this again. There we go. Many of you not have heard about the 78% retracement level. it is a little more hidden than the typical 38%, 50%, and 61% levels. And it is a level that I will go into more detail here once we get to the Fibonacci and the Elliott wave, which is going to be the fourth part of this four-part series. But just a quick snippet of why it's valuable. It's one of my favorite Fibonacci retracement levels, and that's because many traders will recognize the 78% retracement level as the fib of last resort. So a lot of times prices will come through, bounce around the 61.8, and maybe break on through. Well, at 78%, that's where many traders recognize that if there's going to be any support in this trade, it's going to come around this 78% retracement level. And that's because it gives the trader two things. Number one, a lot of other traders use it. So if there's any money behind the traders, they're going to put in a trade, have a relatively tight stop because they would place a stop just below the low, and you could easily get a 1-to-2 or 1-to-3 risk to reward ratio by simply trading the distance of this wave. So you don't necessarily have to worry about any resistance up ahead. Because if you're trading, if your stop is is from the 78.6 down to the low here, well, twice that for a take profit level is going to put you up probably around this level up here. So you can afford a very tight stop when trading it, and then you'll know very quickly if it's going to be a winner or not. Because if it is the Fibonacci support of last resort, and if it does not get supported, then many times prices will blow on through and end up breaking on down through this level. But based on this, the dollar CAD has been in a very strong downtrend, so I would not suggest going long based on the 78% retracement level of the dollar CAD. Would want to see on a daily chart some higher highs and some higher lows get put into place. And you can see that's the farthest thing from the dollar CAD's mind right now. Dollar CAD is in the process of creating lower lows. So we want to let this go ahead and take its place. As a matter of fact, if we're going to trade the dollar CAD, we'd look to trade it going short. If I had to choose between trading the dollar CAD or oil, I would choose the dollar CAD going short versus the oil going long. The reason being is because on a relative basis, the dollar CAD has retraced a larger portion of that move. It is stronger to the downside than oil is to the upside. Harley says, Rob asking, what charting package? This is FXCM's Market Scope Charts. It's part of the FXCM Trading Station 2 platform. I use this probably about 85% of my time. Being an instructor here at Daily FX, I have access to many different charting packages. Some of the charting packages cost upwards of $100 a month, and I spend about 85% of my time using this one, and that's because I do find it easy to navigate around. Having more difficulty with this camera than I am the charts, but it is very easy for me to throw up Fibonacci levels, to draw trend lines, to duplicate those trend lines, and I can navigate through these charts fairly easily. I can change currency pairs fairly easily as well. I've got my whole drop-down list, my time frames, etc. Can even change it between bid and ask prices, buy or sell prices. All right, we got a few more minutes here. We got about 45 minutes in the webinar room, and so we got a few more minutes left. So go ahead and type those questions in the chat box. Any questions about anything that I've talked about? That could be the orders, limit orders, using limit orders, and basically what the encouragement here is. Believe it or not, many traders trade without stops, even though there is a ton of information out there that says you want to trade with a stop on all your trades. And in addition to that, there are many traders that trade without limits. And so by doing so, you're relying on market orders 100% of the time. And so as we discussed earlier with market orders, you have the potential for positive or negative slippage, and people tend to remember that negative slippage. Well, here's an opportunity that when you're out trading your strategy, whether it's a simple support, resistance, trend, and money management type of strategy, or whether it's something a little more complicated, using Fibonacci's, using some MACD crossover on the RSI or something. Whatever the case is, use limit orders to either enter into the trade or use limit orders to exit out of that trade so that you're giving yourself that potential to exit and realize that profit at a level that you've established or better. So it's a situation where the downside to using the limit orders is that it never gets triggered, and therefore, if it's a limit entry, you never got into a potentially losing trade. And we're going to get more into that as we get into the next part of this series, which is going to be on breakouts. And breakouts, as far as the entry on a breakout, we'll actually use a stop entry, but we're going to talk about using limits and take profit levels on these breakout types of trades. Question here, would you do 100% of the orders as limit orders? Well, that's going to depend on your strategy. So, for example, this is the $CAD daily chart. So, would we use 100% of the orders as limit orders? Well, it depends. If you're using a breakout type of strategy, then 100% of your orders are not going to be limit orders, because you're not going to be entering on a breakout strategy. You're not going to be entering at a price that's more favorable to you. So, for example, take a look here at the $CAD. Prices are breaking down to a new low. So if I entered into a breakout trade going short, then I would be entering into a price into the trade at a lower level than where this $CAD is trading at this very moment. So that would technically be a stop entry order. But even though you enter in through a market or you enter in on a breakout type of trade, if you use a limit take profit order, then you're setting yourself up to realize those profits and then also to receive that potential of positive slippage. And this would be huge if you're a day trader or if you're a scalper and you like to go and knock off a couple of pips at a time, because when you're scalping, for example, you're only looking for maybe 5, 10 pips into a trade. Well, if you get a 1 pip positive slip on your take profit order, well, that's 10% of your profit on that trade. So for day traders and for scalpers, using limit orders is going to be extremely important. And it's at that point I would say yes, you would want to have a limit order, limit take profit order on 100% of your trades. As far as whether you enter into those trades at the market or you enter in based on a limit entry, that's going to depend on your strategy. And, would you want to use a limit order even if you wanted to enter in at the price at the moment? Well, that depends. I mean, if I think that it's a good price to enter in right now, I'd go ahead and enter in right now. But then once you enter into that trade, place that limit take profit order on your trade, so that way if you happen to step away and run to the bathroom real quickly and come back, if there's a big quick spike in the market, you're able to go ahead and get taken out of the market at a profitable level instead of coming back and being like, oh man, I had a chance to realize profit and I didn't do so. You mean 1 pip is a 10% of the profit? Well, let me explain that a little bit further. So let's say I'm a day trader, a scalper, and let's say that I'm looking to take profit at 10 pips. Okay. Actually, let me make this a little bit bigger. So let's say I want to take profit at 10 pips. I'm a day trader. I'm a scalper. And you should be able to see the chart now. If I get positively slipped on this trade, that means that I would actually be taking profit at 11 pips. Now, I can't make that happen. It's just a function of the market. The market might give it to me. It depends on the liquidity at that time and the trading that I'm doing. But my goal is I want to take profit at 10 pips. So if I get positively slipped and I'm actually realizing an extra profit on this trade of 1 pip, that means I would be realizing an extra 10% on this trade without doing anything other than placing a limit order on it. And that's on this one particular trade. So yeah, as far as the risk to reward ratio, a 1 to 2 risk to reward ratio, if you're looking to take profit at 10 pips, would be a 5 pip stop, and that would be incredibly difficult. So when you're usually talking to a scalper or a day trader, you're usually going to hear about a flip-flopped risk reward ratio. That means where they're actually going to be risking more on the trade than what they are looking to profit. So if you're looking to take profit at 10 pips, a trader is probably going to risk 20 pips on the trade. And so naturally what that means is you may win 75, 80% of your trades, but when you lose, you're going to be losing two winning trades worth. So it is much more difficult, in my opinion, to trade as a day trader or to trade as a scalper, because you have to be right more often just to break even. And so especially for newer traders, they get excited about the price of the market moving up and down, watching every pip tick off, and so they want to go out and they want to knock off 10 pips and call it a night. And like I said, you'll be right 75, 80% of the time, but it's those trades when you're wrong that will wipe out all those winners, and you put in all that time and all that effort, and you've ended up back to break even or possibly even below break even. So it is appealing because you're right a lot, but we tend to forget what the downside to that type of a strategy is. Now, it is possible that it can be done successfully. It is just much more difficult. And exactly, you also have the cost of spreads in scalping or day trading as well. So if you're looking to take profit at 10 pips and you're trading a 2-pip spread, well, that's the price has to move basically 20% farther just in order to the price actually has to move 12 pips for you to realize that 10-pip take profit level. And I've heard scalpers lose in the long term. I would say, generally speaking, that's true, that you're going to have more scalpers that lose in the long run than are winners. There are a small group of traders who would be able to successfully scalp and who are able to show a profit on a month-by-month basis or on a year-by-year basis, but that's going to be a very small select group of people. All right. Well, we're about 45 minutes here after the hour, and so it is about time for me to wrap this up. Now, if you have any questions here about anything that we talked about, feel free to contact me. I've got my, let me turn the camera back on. I've got my email address located here on the charts, instructor@dailyfx.com. So if you want any information about what we offer at DailyFX as far as education, feel free to contact me. We do 20-plus webinars a week. Also, if you want more information on the limit orders and perhaps how to use them into your strategy, what I would encourage you to do is to send me an email and just have a chart of a trade that you're considering and how the limit orders may play into that type of strategy, and we'd be happy to take a look at that and respond back to you. Now, we're not going to tell you whether it's a good strategy. We're not going to be able to tell you whether you got to enter now or enter at this price or get out at that price. But from a coaching perspective, we'll coach you on how you could tweak that strategy to incorporate limit orders into it. All right. So I want to thank you guys for joining me, and I really want to thank FX Street for putting this on, and Maud and Vicky for helping me get this set up, and apologize for the camera issues that we had. We'll try to resolve that for the next session that we have coming up in 2 weeks. The next session is going to be involving breakouts, and it will be a simplistic view of how you can trade breakouts, very similar to what we saw here today. We're just adding a building block to what we put on today. And then the third part of this series is going to be using an indicator that many of you probably have not heard of to help identify a potential looming breakout. And then we're going to finish up with the fourth part. We're going to be talking about Fibonacci and Elliott wave, and that is a controversial type of topic because a lot of people are interested in Elliott wave. A lot of people are interested in Fibonacci. They really do well together, but the difficult and the challenge of using Fibonacci and Elliott wave is that in real time and trying to use it to identify trades, it's very difficult. The rules are very simple, but applying it is very difficult, and there are people that will study that for years on end and decades just to try to become successful and become an expert at it. So I plan to break down those walls and share with you some easier ways to try to identify and use those Elliott wave counts of Fibonacci and identifying trading opportunities. But again, the focus is going to be on how are we going to incorporate limit orders, limit entry orders, or limit take profit orders into these trading strategies so that we could set ourselves up to benefit from positive slippage. All right, well, thanks again for joining me, and I want to wish you guys the best of luck in your trading, and I look forward to hearing from you. We'll talk to you soon. Bye now.